When people hear the word pension, the immediate reaction is psychological, not analytical. Pension means stability. It means something supervised, regulated, traditional, respectable. But one of the greatest lessons I learned watching investors like Stanley Druckenmiller is that perceived stability and real stability are rarely the same thing. Systems don't break down because they seem risky. They break down because they seem too solid to be questioned. The UK pension system is one of the largest in the developed world, especially in the defined benefit model. This means that millions of people have contractual promises of future income, index promises, promises protected by legal frameworks, promises that seem unshakable, but every financial promise depends on three pillars: sufficient assets, adequate return, and continuous liquidity. If one of these pillars weakens, the structure begins to strain. The problem is that most people confuse regulatory oversight with risk elimination. Regulators can impose rules, they can require reporting, they can monitor solvency, but regulators do not control macroeconomic cycles. They don't control persistent inflation. They don't control external shocks, and they certainly don't control the dynamics of global debt markets. Large institutions, especially pension funds, operate with mathematical models based on assumptions: long-term average growth, relatively stable real interest rates, continuous functioning of the gilt market, and predictable access to liquidity. As long as these assumptions hold, the system appears robust. The risk arises when multiple assumptions fail simultaneously. This is exactly how systemic crises begin. Not with immediate panic, but with invisible, accumulated tension. In 2026, the risk is not a sudden collapse due to a single dramatic event. The risk is a gradual compression of safety margins. Smaller margins between assets and liabilities. Less fiscal flexibility for the state. Lower market tolerance for policy errors. When a system depends on relatively benign macroeconomic conditions to function comfortably, any structural change increases its fragility. And the larger the system, the greater the impact of a dysfunction. The real question isn't whether the system is regulated. The question is it resilient under prolonged stress? Because stability in normal times isn't a test of soundness. The real test occurs when liquidity tightens, when confidence wavers, and when the math no longer favors equilibrium. That's when the difference between apparent security and real security becomes evident. If you want to understand structural risk, you need to study moments when consensus was overconfident. In 1992, the United Kingdom experienced one of the most emblematic episodes in its financial history, Black Wednesday. At that time, the government tried to keep the pound within the European exchange rate mechanism. The idea was to convey stability, discipline, and credibility. But the market realized something that the political establishment ignored. The exchange rate did not reflect economic reality. Pressure mounted, reserves were used, interest rates were raised, and yet it wasn't enough. The Bank of England had to back down. The lesson was simple and brutal. When macroeconomic mathematics clashes with a narrative of stability, mathematics wins. Moving forward to 2008, the pattern repeated itself in a different form. Before the global financial crisis, large institutions were considered too solid to fail. Sophisticated risk models instilled confidence. Rating agencies validated complex structures. But there was an underlying problem: excessive leverage combined with poorly priced assets. When liquidity disappeared, confidence evaporated rapidly. The central point here is not to directly compare these events with the current pension system. It is to understand the common mechanism. In both cases, there was high institutional confidence, dependence on stable market conditions, assumption that interventions would be sufficient to control tensions until they weren't. The British pension system is not currently in an outright crisis. However, it operates within a macroeconomic environment that contains similar elements: high sovereign debt, sensitivity to interest rates, and dependence on functional capital markets. When actuarial models project long-term returns, they assume statistical normality, but financial markets do not operate solely within normality. They operate in cycles. And cycles include extremes. If interest rates remain volatile, if inflation doesn't converge quickly to predictable levels, or if there's a significant external shock, the assumptions built into the models can be simultaneously pressured. That's what we saw in 1992, policy trying to sustain something the economy couldn't support. That's what we saw in 2008. Confidence supporting fragile structures until liquidity revealed the reality. The question for 2026 isn't whether an identical event will occur. The question is whether the current system is prepared for a scenario where multiple macroeconomic variables move against it simultaneously. Because historically, it is precisely in this type of environment that apparent stability is tested and often redefined. If you want to understand the real risk for 2026, you don't need to go back decades. Just analyze 2022. In September of that year, the gilt market suffered a severe shift following the announcement of expansionary fiscal measures. The movement in long-term rates was rapid and violent. What seemed like a market adjustment became, within days, a systemic threat. The critical point was not just fiscal policy. It was the internal structure of pension funds. Many of them used strategies known as LDI, liability-driven investment. The logic was seemingly prudent. Align assets with future liabilities, using derivatives to hedge against interest rate exposure. In theory, it made sense. In practice, it involved implicit leverage. When rates rose abruptly, derivative contracts required additional collateral. Margin calls began. To meet these requirements, funds had to sell liquid assets, including gilts. This created a feedback loop. Forced selling putting pressure on prices. Falling prices requiring more collateral. More collateral requiring more selling. The system approached the liquidity spiral. Stabilization only occurred after emergency intervention by the Bank of England, which initiated temporary purchases of securities to restore market functioning. Now observe this objectively. The system did not collapse, but it revealed structural vulnerabilities. It revealed that funds considered conservative were exposed to market dynamics typically associated with highly leveraged institutions. It revealed that liquidity, under extreme conditions, is not guaranteed. And it revealed something even more important: the dependence on central bank intervention. The central question for 2026 is this: if a new shock occurs, whether due to persistent inflation, currency stress, a geopolitical event, or fiscal pressure, will the response be equally effective? The current environment is different from the pre-2022 one. Public debt is higher. Fiscal credibility is more fragile. The margin for unlimited stimulus is smaller. Interventions always have a cost. They may stabilize in the short term, but they transfer risk to public balance sheets in the currency. The 2022 episode was a technical warning, a dress rehearsal. He showed that the system can function well in stability, but can quickly become strained when volatility and leverage interact. Ignoring this warning would be to assume that the structure was completely immunized. Historically, financial systems are rarely definitively immunized. They are adjusted, and adjusted does not mean invulnerable. 2026 does not require a dramatic political mistake to generate pressure. It simply requires an environment where volatility and structure meet again. To understand the structural risk that may emerge in 2026, it is necessary to analyze the most critical link between the British state and pension funds, the gilt market. Defined benefit pension funds hold large allocations in UK government bonds. This is no accident. The liabilities of these institutions are long-term, predictable, and often indexed. Long-term sovereign bonds seem the natural asset to match these obligations. The problem is not the isolated logic of this strategy. The problem lies in the systemic concentration. When a large part of the system depends on the stability of a single market, in this case British sovereign debt, any tension in that market has amplified effects. Today, the United Kingdom operates with high levels of public debt relative to GDP. This means a greater need for continuous refinancing and additional issuance to cover deficits. The higher the debt, the greater the sensitivity to movements in interest rates. If rates rise, the cost of financing the state increases. If the cost increases, the deficit may widen. If the deficit widens, the need for issuance grows. Now connect this to pension funds. They are structural buyers of gilts, but they are also sensitive to the volatility of these bonds. If there is a shock that causes significant selling or a sharp increase in rates, the impact will not only be on the government, it will also be on the fund's balance sheets. There is also another factor: international confidence. The sovereign debt market is not financed solely by domestic investors. Global investors actively participate. If there is any deterioration in the perception of fiscal or monetary sustainability, external flows may decrease. Lower external demand means greater internal pressure. And if in an extreme scenario, pension funds are simultaneously adjusting positions due to collateral requirements or risk management, the market may experience disproportional volatility. This is the critical point. The risk is not just high debt. Many economies operate with high debt. The risk is interdependence. The state depends on the gilt market to finance itself. Funds depend on the gilt market to balance liabilities. The market depends on sustained confidence and deep liquidity. When three pillars depend on the same foundation, any structural fissure propagates rapidly. In 2026, the combination of high debt, refinancing needs, and recent memory of volatility may make the system more sensitive to shocks than it appears. And interdependent systems don't fail gradually. They maintain stability until multiple pressures converge. It is at this point that the sovereign debt trap ceases to be a theoretical concept and becomes a practical risk for those who depend on the pension system. There is a risk that doesn't depend on the market, monetary policy, or daily volatility. It evolves slowly, almost invisibly, but it is structurally inevitable. Demographics. The United Kingdom, like most of the developed world, faces a progressively aging population. The proportion of people above retirement age is growing, while the base of active workers is expanding proportionally at a much slower pace. For a pension system, this alters the fundamental equation. Defined benefit pensions were conceived in an era when life expectancy was lower, economic growth was structurally more robust. The relationship between contributors and beneficiaries was more favorable. Today, that relationship has changed. People live longer. This is positive from a social point of view, but financially it means payments for longer periods. At the same time, the birth rate is lower than in previous decades. This reduces the future contributory base. Now connect this to actuarial mathematics. Solvency calculations assume certain long-term average returns and certain contribution flows. If the duration of payments increases and economic growth slows, the safety margin decreases. The problem is not immediate. It doesn't generate dramatic headlines, but it creates structural compression. More payments, less proportional growth in the contribution base, greater dependence on the performance of financial assets. If the macroeconomic environment is favorable, reasonable growth, controlled inflation, stable markets, the system can absorb this pressure. But if 2026 brings prolonged volatility, below average returns, or new fiscal disruptions, the demographic impact amplifies the tension. Another critical point is political behavior. When the proportion of retirees grows, so does social sensitivity to benefit adjustments. This reduces the flexibility for profound structural reforms. Adjusting the retirement age, altering indexation, or modifying calculation formulas becomes politically more difficult. This means that the system's ability to adapt may be limited precisely when pressure increases. Demographics are not a speculative variable. They are not a market prediction. It's a measurable statistical trend. And when combined with high public debt, sensitivity to interest rates, and dependence on liquid financial markets, it transforms a seemingly stable system into a progressively more rigid one. Rigid means less room for maneuver. And in finance, less room for maneuver means greater vulnerability when the environment changes. In 2026, the demographic factor will not be the visible cause of any tension, but it could be the silent amplifier of any shock that arises. There is a fundamental difference between volatility and dysfunction. Volatility is price movement. Dysfunction is the inability to trade in an orderly fashion. What transforms an uncomfortable situation into a systemic crisis is almost always liquidity. Liquidity means the ability to buy or sell assets without causing severe price distortions. Under normal conditions, the UK gilt market is considered deep and efficient. There are institutional participants, banks, insurance companies, and international funds. But liquidity is not a permanent attribute. It is conditional. It depends on confidence, a balance between buyers and sellers, and the absence of simultaneous pressure. The 2022 episode clearly demonstrated this. When multiple pension funds needed to sell assets simultaneously to meet margin calls, the market began to lose depth rapidly. Spreads widened, prices moved abruptly, and the cycle became self-reinforcing. Liquidity evaporated precisely when it was most needed. Now consider 2026 in a scenario of higher public debt, a constant need for refinancing, and a potentially volatile macroeconomic environment. If there is a new inflationary shock, currency stress, a relevant geopolitical event, or simply a global risk reassessment, the market may face simultaneous pressure from several sides. Pension funds do not operate as tactical traders. They have real monthly obligations. They need to pay benefits regardless of market conditions. This means that under stress, they cannot simply wait. If assets need to be liquidated to generate cash, a sale occurs. And when many participants sell at the same time, the price ceases to reflect fundamental value and begins to reflect an immediate need for liquidity. This is the critical point. Actuarial models work well under normal volatility. They are not designed for environments where liquidity squeezes rapidly. Furthermore, after the 2022 episode, adjustments were made, collateral requirements were revised, strategies were adapted. But adaptation doesn't eliminate risk, it only reduces it under specific assumptions. Structural risk remains when the system as a whole depends on the continuous and orderly functioning of the same market. Liquidity is invisible while it exists. It only becomes relevant when it disappears. And historically, when it disappears, the speed of deterioration surprises even experienced participants. In 2026, the central risk is not a gradual and predictable decline. It's the possibility of a rapid liquidity squeeze that transforms manageable tension into systemic pressure. This is the type of risk that doesn't appear in quarterly reports, but it's the type of risk that redefines financial results in a few days. If there is a variable capable of simultaneously pressuring assets, liabilities, and economic policy, that variable is inflation. For more than a decade after 2008, the developed world operated in an environment of low inflation and structurally low interest rates. This scenario favored financial assets, stabilized financing costs, and made many actuarial models predictable. But the recent period has shown that inflation was not eliminated, it was merely dormant. When inflation rises above the target, the central bank faces a dilemma. The Bank of England has a price stability mandate. To contain persistent inflation, it needs to maintain a restrictive monetary policy for a sufficient period of time. Higher interest rates have direct effects. First, they increase the cost of financing the government. Second, they reduce the market value of already issued bonds. Third, they compress the valuation of multiple financial assets. For pension funds, this creates a complex dynamic. On the one hand, higher rates improve the discount rate used to calculate future liabilities, which may seem positive from an actuarial point of view. On the other hand, rapid and volatile movements in rates generate mark-to-market losses and a potential need for collateral adjustments, especially when derivative instruments are used. Now consider the alternative scenario. If the central bank eases monetary policy too early, seeking to reduce pressure on public debt or stimulate growth, it may face currency devaluation and renewed inflationary acceleration. In this case, the purchasing power of pension beneficiaries is eroded. Even when benefits are indexed, they rarely perfectly track the real inflation perceived by families. This is the double impact. High inflation harms beneficiaries. High interest rates put pressure on financial assets and increase volatility. The ideal environment for pension funds is predictable stability. Moderate inflation, stable growth, relatively anchored interest rates. The problem is that 2026 may not offer this balance. If the UK faces modest growth with persistent inflation, monetary room for maneuver will be limited. Prolonged restrictive monetary policy could slow the economy. Excessively expansionary policy could damage currency credibility. In either case, the pension system operates in a less comfortable environment. The central point is not to predict hyperinflation or monetary collapse. It is to recognize that monetary regimes change. And when the regime changes, models built on old assumptions need adaptation. If the transition is orderly, the system adjusts gradually. If it is abrupt, volatility can expose weaknesses that remain invisible during times of stability. 2026 may represent precisely a period of regime transition. And regime transitions are historically the moments when underestimated risks become evident. Most people monitor their pension balance as if it were a long-term bank account. They look at the total amount. They see annual reports. They trust the management. But almost no one analyzes the internal architecture of the system. And that's exactly where structural risk usually lies. When discussing defined benefit pension funds, it's essential to understand four technical dimensions that are rarely discussed publicly. First, sensitivity to the yield curve. Small variations in long-term rates can significantly alter the present value of liabilities and associated assets. Second, indirect exposure to derivatives. Even if the fund appears conservative, risk management strategies may include instruments that amplify market movements under stress. Third, systemic concentration. Many funds use similar structures, similar advisors, and similar models. This creates collective behavior. When one adjusts its position, others tend to do the same. Fourth, implicit dependence on state stability. There is a widespread belief that ultimately the state will act to prevent serious dysfunction. This expectation shapes risk decisions. The problem is not that these characteristics are inadequate by definition. The problem is that they make the system highly interconnected. Interconnection increases efficiency in normal times, but under stress, interconnection transmits shocks more quickly. Many beneficiaries assume that diversification within the fund means sufficient protection. However, if much of the diversification remains within the same financial ecosystem, domestic sovereign bonds, local corporate credit, assets correlated to British rates, the protection may be less than it seems. Structural risk does not mean that losses will occur tomorrow. It means that if a sufficiently strong event occurs, the impact could be amplified by the structure itself. Another frequently overlooked point is the difference between actuarial solvency and operational liquidity. A fund may be considered solvent in long-term projections and still face severe pressure if it needs immediate liquidity in an adverse environment. This distinction is critical. Reports may show projected balance over 20 or 30 years, but the market operates in days and weeks. In 2026, the risk is not necessarily a massive declared deficit. There is a possibility of rapid operational stress requiring difficult decisions, strategy adjustments, increased contributions, reassessment of future benefits. Most people don't track these technical indicators. They track confidence, and confidence is stable until it isn't. Understanding the structure behind the balance sheet is the first step in assessing real risk, because isolated numbers don't tell the whole story. Financial architecture determines how the system reacts when under pressure. When I talk about structural risk, many people interpret it as an invitation to panic. It's not. Throughout my career, the central principle has never been fear, it's been asymmetry. The correct question isn't, will the system collapse? The correct question is, what is the cost of being completely dependent on a single structure if it comes under pressure? Experienced investors don't try to predict with absolute precision, they build in safety margins. If 2026 is a stable year, with moderate growth and inflation under control, the pension system will likely continue to function without major disruptions. But if there is a combination of prolonged volatility in interest rates, additional fiscal pressure, experience may differ from average expectations. Rational protection begins with true diversification. Diversification does not mean owning several assets that react the same way to the same macroeconomic factor. It means reducing structural correlation. If a large part of your assets is tied to the performance of the British financial market and the fiscal stability of the United Kingdom, you have both geographic and systemic concentration. Reducing this concentration may involve international exposure in strong currencies, real assets with inflation hedging characteristics, maintaining strategic liquidity outside the core system, flexibility to adjust allocations when the macroeconomic regime changes. This does not imply abandoning the pension system. It implies not depending exclusively on it for future financial security. Another critical element is understanding the type of plan you have, understanding indexing rules, understanding formal guarantees and legal limitations. Knowledge reduces psychological vulnerability and improves decision-making. Furthermore, hasty decisions based on headlines rarely produce good results. Effective protection is planned during periods of stability, not during crises. The central point is simple. If the adverse scenario doesn't occur, you've paid a limited cost for being prepared. If it does occur, the preparation can preserve financial independence. That's the essence of asymmetry. It's not about predicting the exact moment of stress. It's about accepting that complex systems can be pressured, and that excessive concentration increases impact. In 2026, the risk may not be catastrophic, but it could be significant enough to alter long-term financial trajectories. If the adverse scenario doesn't occur, you've paid a limited cost for being prepared. If it does occur, the preparation can preserve financial independence. That's the essence of asymmetry. It's not about predicting the exact moment of stress. It's about accepting that complex systems can be pressured and that excessive concentration increases impact. In 2026, the risk may not be catastrophic, but it could be significant enough to alter long-term financial trajectories. Adjusting before tensions arise is always more efficient than reacting after they have become evident. Throughout this analysis, I did not present a dramatic prediction. I did not speak of inevitable collapse. I did not present a dramatic prediction. What I did was something more important. I analyzed probabilities. When you simultaneously consider high public debt, structural sensitivity to interest rates, increasing demographic pressure, significant dependence on the gilt market, recent history of liquidity stress, you don't need to predict disaster to recognize vulnerability. Financial systems rarely break down due to a single isolated cause. They come under stress when multiple factors converge. In 2026, an extreme economic policy error is not necessary to generate pressure. A less favorable macroeconomic environment than assumed in the models is enough. If growth is weaker than expected, if inflation remains resistant, if global volatility increases, the system's safety margin may be tested again. The central point is this: risk is not what appears in the headlines every day. Risk is what seems improbable until it ceases to be. And the biggest financial mistake I see repeatedly is complacency. The belief that because something has worked for decades, it will continue to work the same way under any circumstances. Discipline means questioning assumptions. It means assessing concentration. It means accepting that historical stability does not guarantee future stability. If you depend on a pension in the UK, the ultimate responsibility does not lie with the government, the regulator, or the fund manager. It's yours. Understand the structure of your plan. Assess your overall exposure. Build a safety margin outside the core system if necessary. Preparation is not pessimism. It's rationality applied to complex systems. 2026 could be a stable and predictable year. It's possible. But if it isn't, those who thought about probability and not just hope will be in a stronger position. If this analysis brought clarity and helped you think more strategically about your financial future, subscribe to the channel now. Here we analyze cycles, structural risk, and wealth preservation based on discipline, not emotion. Because in the end, markets change, regimes change, but responsibility and prudent risk management remain the only consistent defenses over time.